The dot-com delusion, a cautionary tale of tech bubbles. In the late 1990s, an economic whirlwind swept the globe, a speculative storm that would ultimately bring countless affluent individuals and investors to financial ruin overnight. This frenzy, fueled by dreams of endless prosperity, captivated the imaginations of millions. This wasn't just a loss of wealth. People lost their homes, their jobs, their reputations, and their secure futures. Entire families saw their life savings vanish, leaving them to rebuild from scratch. This is the compelling story of a time when the mere phrase .com acted like a magic word. It was a term that sparked both awe and recklessness in equal measure. Initially, it conjured fortunes, transforming ordinary people into millionaires. But in a shocking reversal, that same word became the architect of their downfall. The promise of instant wealth turned into a cruel mirage for many. This is the saga of the technological frenzy the world now remembers as the dot-com bubble. It remains a stark reminder of how quickly euphoria can turn to despair. Yet, if one observes the current landscape, an unnervingly similar technological storm appears to be gathering even now in 2025. The parallels to the past are striking, raising questions about whether history is repeating itself.
Welcome back to another thrilling story from Deep Dive Diaries.
The spark of the revolution. Every great revolution is ignited by a tiny spark, and the dot-com bubble was no exception. That spark came from an unexpected source, setting the stage for a transformative era. That initial spark was a relatively unknown piece of computer software called Mosaic. Developed by a small team at the University of Illinois, it was a breakthrough few could have predicted. Back in 1993, the internet was a barren, monochrome space navigated only by dull, text-based browsers. It was a niche tool used mostly by academics and tech enthusiasts. Mosaic changed everything. Its user-friendly interface made the internet accessible to the masses. It unveiled a miracle to the world by becoming the first popular web browser capable of displaying pictures alongside text. This innovation turned the internet into a vibrant visual playground. It transformed the internet from a purely functional utility into a visually engaging medium, marking the very first blaze of the internet's commercial era. Businesses began to see the potential for reaching global audiences through this new digital frontier. It was as if the internet had suddenly sprung to life. The colorless pages slowly began to burst with color and graphics. Websites became more than just text. They became experiences. Behind this digital enchantment was a young programmer named Mark Andreessen and his visionary team. Their ambition and creativity laid the foundation for the internet we know today. They realized they had accomplished something monumental. Their innovation wasn't just technical, it was cultural, reshaping how people interacted with technology. They founded their company and named it Netscape. With Netscape, they aimed to dominate the emerging browser market and capitalize on the internet's growing potential. In August 1995, Netscape executed a move that sent a seismic shockwave through Wall Street and the world's stock markets. The event was a turning point, redefining how markets viewed technology companies. They announced their intention to sell shares of their company to the public in an initial public offering, IPO. This bold decision captured the attention of investors worldwide. Initially, they priced a single share at an already ambitious $28. At the time, this price seemed audacious for a company with minimal revenue. However, the moment the market opened, Netscape's stock price soared to a staggering $75, eventually closing the day at $58. The frenzy surrounding the IPO was unlike anything Wall Street had seen before. A company that was barely turning a profit, a company whose primary product was just a browser, had been instantly valued at $2.9 billion. This valuation defied traditional financial logic, which prioritized steady profits over potential. But the success wasn't Netscape's alone. It set a precedent that would shape the tech industry for years to come. The investors who had bought shares at the initial $28 IPO price saw their investment nearly double in a single day. This overnight windfall created a sense of invincibility among early investors. For the global investment community, this was a clear signal. If a company's name ended with .com, its valuation could instantly shoot for the stars regardless of whether it was currently profitable. The term .com became synonymous with limitless opportunity, fueling a speculative fever. This powerful signal gave birth to a dangerous new investment mantra: profit is optional, growth is king. Traditional business metrics were cast aside in favor of hype and potential. The focus shifted entirely from generating earnings to simply seeing the share price increase. Investors became obsessed with stock price momentum rather than sustainable business models. Suddenly, investors were clamoring to buy stock in any company that had a .com attached to its name, not to share in the company's profits, but simply to capitalize on the explosive growth in its stock price. This mindset created a feeding frenzy where rational analysis was abandoned. Following Netscape's stunning success, the .com gold rush began in earnest. It was a modern-day gold rush with the internet as the new frontier. Entrepreneurs rushed to launch any kind of internet company they could conceive. From online bookstores to virtual pet stores, no idea seemed too outlandish. Venture capitalists, the people who fund new businesses, began blindly throwing immense sums of money at virtually anyone. They were driven by the fear of missing out on the next big thing. Companies sprang up for every possible niche: a site for selling pet toys and accessories called Pets.com, a high-end online fashion store named Boo.com, an online toy retailer, eToys.com, and an ambitious online grocery delivery service, Webvan.com. Each of these companies promised to revolutionize their respective industries. The frenzy reached an astonishing peak. Over a mere 2 to 4 years, the year 1999 saw 457 companies launch their IPOs, most of which were .coms, with their share prices jumping 80 to 90% on the very first day of trading. This level of market enthusiasm was unprecedented, creating a bubble of valuations detached from reality. This was an era when wealth was being created seemingly out of thin air. Ordinary people became overnight millionaires, at least on paper. Even an average person with no prior knowledge of the stock market was pouring their life savings into .com stocks. Teachers, doctors, and retirees all joined the frenzy, hoping to secure their financial futures. This collective euphoria was described by Alan Greenspan, the then chairman of the U.S. Federal Reserve, as irrational exuberance, unreasonable enthusiasm. His warning was a rare moment of clarity in a market blinded by greed. He subtly warned that the market's greed had exceeded all rational limits, likening it to a balloon rapidly being filled with air, ready to burst at any moment. Yet his cautionary words were drowned out by the roar of the market's optimism. But his words were widely mocked and dismissed because everyone was making money. The promise of quick riches silenced even the most prudent voices. The fear of missing out was all-consuming. It drove people to invest without due diligence, chasing trends rather than value. .com CEOs swaggered like rock stars. They were celebrated as visionaries, their every move watched by an adoring public. Boo.com, the online fashion retailer, notoriously blew through $188 million on lavish expenditures in just 6 months. From extravagant office spaces to private jets, no expense was spared in their quest for attention. Another company, Pixelon, spent $16 million hosting its launch party in Las Vegas, complete with performances by famous bands. The event was more about spectacle than substance, designed to dazzle investors. Countless companies with no viable business model and low inherent worth resorted to extravagant marketing parties, not to sell products, but to hype their stock and attract new investors. These events became symbols of the era's excess, where image trumped reality. These companies were only able to survive as long as a fresh supply of new investors kept pouring in. Their business models were often unsustainable, relying on hype to maintain momentum. The slow inflating balloon was finally ready to pop, and several factors contributed to the inevitable crash. The collapse was not a single event, but a series of cracks in the market's foundation.
The Y2K bug fear. In late 1999, global anxiety surged over the Y2K bug. People feared that when the year rolled from 1999 to 2000, older computer systems would reset to 1900, causing widespread crashes in banks, power grids, and transportation. Though the disaster never materialized, the fear generated significant market unease, causing investors to start selling stocks before the millennium, the first pinprick in the balloon. In February 2000, Federal Reserve Chairman Alan Greenspan made the decisive move that broke the stock market's back. He raised interest rates. This policy made borrowing money from banks more expensive, but it also meant that holding money in bank accounts offered a greater return. Consequently, investors began pulling their money out of volatile stocks and placing it into safer, higher-interest bank accounts. The dot-com companies, which relied on a constant influx of new investor cash to survive, began to see their funding dry up. The final nail in the coffin was driven by Japan. Considered the technological king of the time, Japan announced in March 2000 that its economy was entering a downfall. This created panic. If the technological powerhouse of Japan was faltering, what hope did the overvalued U.S. tech stocks have? The news triggered a massive, panicked sell-off of risky stocks, and the riskiest stocks of all were the dot-com companies. The aftermath and the lessons learned. The 3 pinpricks were enough. The Nasdaq Stock Exchange, heavily weighted with tech companies, began to crash in a terrifying domino effect. The index, which had peaked above 5,000 points in March 2000, plummeted by over 80% in the next 2 years, hitting a low of just over 1,000 points. An investment of $100,000 was now worth barely $20,000. The storm vaporized approximately $1.75 trillion in market value. Companies that were once worth billions became worthless. Thousands of businesses like Pets.com, Webvan.com, eToys, and Boo.com were forced to shut down. Millions lost their livelihoods, and those who had once considered themselves geniuses were left ruined and humiliated. The dot-com dream had devolved into a nightmare. However, from the ashes of the crash, a few companies not only survived, but emerged to eventually dominate the world: Amazon, Google, eBay, and Apple. They survived because they possessed the one thing most dot-coms lacked: a solid, sustainable business model. History repeating: the AI bubble of 2025. Experts agree that while it's easy to blame the dot-com companies, the real culprits were the investment banks, capital markets, and venture capitalists whose greed fueled the fire. The dot-com bubble was a brutal lesson for the internet age. No matter how revolutionary the technology, the fundamental rules of business always apply. Yet, astonishingly, it appears the world may not have learned from the 25-year-old storm. Today, in 2025, the same excessive zeal and speculation are being directed towards new technologies like crypto and artificial intelligence, or AI. Companies big and small are attracting massive investment simply by slapping the words AI or blockchain onto their names, even when their connection to the technology is tenuous at best. A perfect living example is the story of Builder.ai. In 2023, a lavish launch party was hosted at a 5-star hotel in Vietnam, attended by global celebrities. The occasion was the unveiling of a new technology that claimed its AI could build apps without a single line of code. Hypnotized by this promise, major investors, including Microsoft and SoftBank, poured $250 million in funding into the company in a single day. The company's valuation quickly soared to $1.5 billion, hailed as the future of AI development. But the facade began to crumble. An investigation revealed a starkly different reality behind the AI curtain. The apps were not being built by AI, but by a vast, undisclosed network of human engineers in countries like India, Vietnam, and Romania. Builder.ai was simply a front, a marketing trick leveraging the AI hype. Furthermore, the company was accused of round-trip billing, generating fake transactions to artificially inflate and misrepresent its revenue. As these facts emerged, the story began to sound terrifyingly familiar to the dot-com bubble. The company is currently under a fraud investigation. Have we truly learned from history? Or are we marching straight into a new and potentially even larger bubble? What is your take on the current excitement surrounding AI and other emerging technologies? Be sure to let me know in the comment section below. I hope you thoroughly enjoyed and will share this Deep Dive Diaries video. We'll meet again in the next spectacular video.